Okay, great. Good afternoon, everybody. Jeff Beglin here, and normally I'm on the Cornerstone side of the house, but today I am pinch hitting for ARC Benefit Solutions, and I'm hosting the annual webinar with our good friend Dennis Heywood, and we're going to discuss basics, myths, and perils about Social Security for 2025. Before I hand it off to him, I am going to go over a couple things. If you got a question, you want to put it in the question box. We're actually going to monitor it throughout the presentation, and we'll jump in at various times. Be sure to add those questions. And then what's more, you'll also see a paperclip on your desktop that is a download, some materials that Denny wanted to share with you. And by all means, have your questions at the ready. Here's some information about ARC Benefit Solutions at the lower right-hand corner. These are your phone numbers in order to reach out to our agents and the contact information. So with that, I'm going to toss things over to Denny. Denny, can you hear me?
I can hear you, Jeff.
Okay, let me put that screen up real quick and we'll get started.
Okay.
It looks like you accidentally didn't share your screen or unshared your screen, Jeff. You might need to reshare it.
Okay. Well, I need to share that.
It just unshared entirely, so you just.
Yeah, I need it to go there, and now I'm going
Yeah.
to put it up in the presentation mode. Jess, can you see this? Is it working? Does that look good?
Yes, that's perfect.
Okay.
Yeah.
Danny, can you see that? Obviously, you've got your screen up. So we've got the title page up. Yeah, we got the title page up, and we'll just flip through, and then you just tell me next slide. Okay. So here we are, Social Security Entitlement 2025. Take it away, Denny.
All right. Thank you, Jeff. Jessica. Welcome, everyone. We have a banner year for Social Security this year. There's a lot of myths and perils. Well, enough to, and one or two would be plenty. But we're going to go over some information here that is basic to anyone filing for Social Security and wanting to start Social Security or understand Social Security. So this is my title page, and there's my website and phone number. Feel free to contact me after the session. But we're going to jump right into this. And if you would, I'm going to the first page on Social Security and Medicare taxes. And if you would look at your update, that paperclip that Jeff was talking about, that covers this information in the top half of the first page. All right. Basically, how do they get the money? Okay. They tax you on your earnings, self-employment or wages, and the first $176,100 this year is taxable at 6.2%. Goes into the trust fund. The self-employed pay 12.4% on their earnings. That goes into the benefits trust fund up to $176,100. So this is the tax base, and I will tell you there's a question's going to come up, so I'm going to answer it before it comes up. What are they doing? Is it going to be there for me? I just got a call from the Dayton Daily News last week, and they wanted the interview, and they heard that we were going to run out of money in 7 years, and people would definitely be taking a 20 to 30% cut. That is nothing but hogwash, and that's fear tactics, and it's whatever you want to call it. But I have not been informed that anything like that will take place. What they will do, they're going to raise that tax base. That $176,000, that could go to $500,000 or more. And they're going to tell kids like my son and who are entering their 50s that, hey, if you were born after, let's say, 1970, okay, you're not going to be able to take your benefit until you're 65, not at 62. And they may take away the 8% delayed retirement credits. They may do a lot of things, but they haven't so far have hit the pocketbook of those receiving benefits. They have hit the ones that haven't started receiving yet, but that was back in 2015 and 16. So they're going to make some changes. It's going to be there. We're not going to run out of money. The current administration is making a lot of changes to Social Security itself, its administration, and across the board at lightning speed. What seems like lightning speed, but it's really not that much. They did cut a lot of staffing. And so the Social Security funds are going to be there. Now, when will they make that change? They'll probably make it at 11:59 p.m. the day before it needs to be made, before things crash, quote unquote. So these are the tax bases. Medicare tax base, 1.45% on all earnings, 2.9% on all earnings on self-employed, and then there's an additional tax on those who make more than $200,000 a year. So they're going to firm up the trust funds, and it's going to be there. So let's get into the technical matter of what are the concepts that you need to know. And there are two big ones: earnings limits and full retirement year. Those two things we're going to discuss now on the next slide.
Okay, got that.
Your full retirement age. Well, Social Security, I created this. This is another term. This is more, well, let's say easier to understand. But Social Security refers to it as your PIA, primary insurance amount. Your full retirement age benefit is the benefit when the month and year you turn full retirement age. And for people born in 43 to 54, it was the month and year they turned 66. Now we're looking at people born in 1960 or later, and their full retirement age is when they turn 67. Okay? If you were born in 1958, it's the month you turn 66 plus 8 months. So if you were born in June of 1958, your full retirement month is June plus 8 months, January of the next year. So this is the month. The significance of this particular concept is at that point, you no longer take a reduced benefit at your full retirement age in your full retirement month. Your benefits no longer reduced. The other significant thing about your full retirement age is that you're allowed to make as much money as you want to from a job or self-employment. So now I'm going to go to the next slide and talk about earnings limits. We've always had these earnings limits. And these earnings limits in 2025, if you're not in your full retirement year, your earnings limit is $23,400. And when I say earnings, I'm talking about wages from a job or self-employment income. One of the two. They're not looking at anything else. So if you're making $23,400, which is $1,950 a month, and less than that, then you can take your benefit with no loss in benefit. And this is covered on the bottom half of the update page. I get the front page on the bottom half, earnings limits. So if you earn over that $23,400 in a year and you're getting benefits, they withhold $1 in benefits for every $2 you earn over that $23,400. So keep it simple, if you made $24,400, you'd be $1,000 over the limit. And they would withhold $500 in benefits and then keep paying you for the rest of the year. But here's the problem. Most people make much more than $23,400 and therefore cannot file for benefits until the point at which they quit working or turn full retirement age. So this $23,400 limit, if you look on the update, in 2024 it was $22,320. In 25 it's $23,400. It's going to go up about $1,000 a year as years go by. Now, in your full retirement year, that earnings limit changes. In the year of your full retirement, if this 2025, if this year were your full retirement year, you would be able to earn $62,160 with no loss in benefits, and then they would pay you accordingly. They would look at the months prior to your full retirement month. So if your full retirement month was April, they're only counting your earnings January, February, and March. And if you're making $100,000 a year, you're really only making about $24,000 January, February, March. And you could take your benefit, let's say $3,000 a month, starting in January of your full retirement year. You would take a slight reduction, maybe a $30 or $40 reduction, and your benefit, instead of being $3,000 a month, which it would have been in April, might be $2,970 a month. And you would draw that for January, February, March, and continuing, because you're not earning over the limit prior to your full retirement month. This is one of the perils people get into. Well, I'm going to wait till my full retirement month. Well, okay, but you do realize you're leaving about $9,000 on the table that you could put in your pocket now, if you wanted to. The earnings limit in your full retirement year only applies to months prior to your full retirement month, period. Now, there are special rules for the first year of your retirement. Let's say you were 63 years old and you're going to quit working, and you're going to quit June the 30th, and you're making $200,000 a year. And so you will have made by June the 30th $100,000. You'd be way over that $62,160 or the $23,400. But you're 63 years old, so this lower earnings limit applies to you, $23,400. So in June, you tell Social Security, I'm going to take my benefit in July, even though I've made $100,000, because they give you a special break the first year you retire. You can go ahead, and if you've made over the limit through the month you stop working, if you don't make over the limit or the monthly limit after that, $1,950 a month, you can take your benefit with July. That's a special year in the first year you retire. After that, they're looking at how much you're making for the whole year. But they do give you that break. Some payments don't count as wages after you retire, like deferred wages, stock options, severance pay. It's not held against you. Let's say you had $30,000 in stock options and you had deferred wages, and you were quitting work June the 30th, and you were 63 years old, but you're going to exercise these options. You're going to keep getting money and a W-2 after June the 30th. But none of that money was earned prior to June the 30th. It was all, prior to July 1st, it was all earned previously. So they don't hold that against you in going forward and taking benefits. A lot of people don't know that, and they think, now there's something special that you got to do. You've got to get a letterhead from your employer which says this person, Joe Smith or Sally Smith, did not work after June 30th. These are deferred wages or stock options. So in taking it early, that's always a possibility. And these earnings limits always apply. So if you quit working, decide to take your Social Security, and then go back to work a year later, and you're not your full retirement age, you're subject to these earnings limits. I've heard comments from some financial planners that say, well, if you go back to work, we're just going to turn off your Social Security. There's no turning off the Social Security. You can't flip a switch and say, don't pay me. They're looking at your earnings, and they're going to pay you based on your earnings. no matter what you tell them. You may tell them, I'm not going to make 23,004 and then go back to work and make over the 23,400. Then you've got to pick up the phone and call them and say, hey, I'm going to make 50,000 this year. You got to put me in an offset. These are the basic concepts: earnings limits and full retirement age. Now, the next slide, we want to talk about eligibility factors, retirement, spousal benefits. Now, we're down in a special area here. The factors of entitlement for retirement and spousal benefits. Okay? You must be 62. To get a retirement benefit, you need 40 quarters of coverage. For a spousal benefit, you must be legally married for at least 1 year to the wage earner. A divorced spouse can get spousal benefits if they've been legally married for 10 years. We'll talk about how spousal benefits are figured as opposed to your retirement benefit. If you're a divorced spouse, you must have been legally married for 10 years. And if you are an independently entitled divorced spouse, the 10-year, 2-year rule, what is that about? Independently entitled divorced spouse is a spouse whose ex has not filed for benefits, but their ex is at least age 62 and eligible to get benefits. And the divorced spouse can file on his or her record if they are entitled to spousal benefits, even if they haven't filed. It's a special category of divorced spouse. The rule is they must have been married for 10 years before they were divorced, and they must have been divorced for at least 2 years for that spouse to file on independently. Refers to the fact that the basic wage earner has not filed for benefits. Earnings limits apply in all of these cases until your full retirement month, and you can file an application online or call for an appointment. Good luck on the appointments. We'll talk about that a little bit later. These are the eligibility factors for retirement and spousal benefits. Now we're going to go to the next slide.
Okay, and guys, if you have any questions, don't hesitate to put them in the question box. I'm going to flip to the next slide for you, Denny.
Okay. Retirement / spousal filing options. What's that? Well, you can file for retirement benefit or a spousal benefit at age 62. That's going to get you a haircut of about 30% reduced benefit. So if you would wait until your full retirement age, let's say 67, and you could have got $2,000 a month. If you take it at 62, you're probably going to get around $1,400 a month. Second bullet, January of your full retirement year. I mentioned this in talking about the earnings limits in your full retirement year. Just note to self, most people, if their full retirement month is early in the year, by say July or August, most people can file effective January, take a reduction, January of their full retirement year, take a reduction, and you would draw benefits at least for part of January through June or July. Concept being, you're going to take a reduction, but put some bucks in your pocket. Now, sometimes it's not always a good thing to do. If you're making $300,000 a year, well, they're going to have to withhold some benefits, and we got to do the math on it. But note to self, January of your full retirement year, you want to check the fall before your full retirement year, October, November, December, to see if you could be eligible for a payment starting in January. instead of waiting until your full retirement month in July. At your full retirement month, there is no reduction. So you're going to get your benefit. And I had a good conversation with somebody about a week ago about, I thought I'd draw the max. Well, you will draw the max, but only for the years you paid max in. And if you stop paying maximum 2 years ago, you're going to get the maximum based on the number of years you put in. So your full retirement month, there is no reduction. And you would draw your own maximum benefit, not the maximum benefit. The maximum benefit this year for a retirement benefit is $4,018 a month. That's the maximum full retirement age benefit anyone can get. And that means that they have contributed to the system for 35 years, paid maximum into the last 35 years, paid maximum each year into the Social Security Trust Fund. From 2024 on back to 1999 and 10 more years back, 1989. 35 years. Social Security uses your highest 35 years to compute your benefit. And they're always looking. Like next year, they'll look at what you made this year if you were making good money, and they'll replace a low year with it, and your benefit will go up. Might go up $10, $15 a month. The other choice people have is delayed retirement credits. That's where your full age retirement benefit, your PIA, if it's $3,000, you would get 8% a year from your full retirement month, FRM, to age 70, credited to your record. And for most people now, if you're in a maximum benefit situation, that's about $1,000 more, roughly, if you're waiting until 70. I'm not a big fan of this. I think at full retirement age, I'd rather have control of my money than the government. But this is something that was done years ago more often than not because of spousal benefits were payable. Now they are not. There's no filing in restrictions. So the spousal benefit, last bullet, is payable only if your spouse is receiving his or her retirement benefit. And again, we'll talk about how to compute the spousal benefit. The only exception to this is for a divorced spouse, independently divorced spouse, which means they've been married for 10 years, divorced for 2 years. Let's say in traditional situations, usually he is at least age 62 and she's 62, and she can file on his record if she's due anything as a spouse. Okay.
Before I go to the next slide, Denny, got a question. We want to get a question. This is from Michelle, and on September 2nd, I turned 62. Do I have to wait to the new year to apply? I make $38,000 a year, and I will get penalized because I made too much? Question mark.
Well, the other factor that comes in here, Michelle, is how much is your benefit going to be at 62? Okay, and probably not, because you're making about 38,000. Let's round it off to 40. You're about 19,000 over the limit. They're going to have to withhold $10,000 in benefits, and the months they can withhold it for is October, November, December. So you're probably, look at 38,000 next year, starting in January. If you're making 38,000, you may want to look at filing. This is what I do, and on my website I call it a Social Security analysis. Because, Michelle, they only have 3 months to withhold your benefit. You're only entitled starting October, not with September, because you're born on the. If you were born on the 1st, you'd be entitled to the whole month of September's benefit. But you were born on the 2nd, so the first month you're due a reduced benefit would be October, and they're only going to get to withhold 3 months checks, and that's probably more than your monthly benefit is. So it's a no. It's a no on that.
Okay.
Okay?
Hope that helped. And
Okay.
let's go next slide.
Okay,
Auxiliaries.
next slide.
Yeah.
Auxiliaries. Here are auxiliaries. Well, who are they? Wives and children, period. Okay? They're eligible on your retirement or disability record. Okay? Who's eligible? A spouse or divorced spouse who is at least age 62. That's who's eligible. Okay? Eligible does not mean entitled. It means you could get it. Let's do some math, though. The spouse or divorced spouse, any age with a child under age 16 in their care. I just had a client who was, he's 67 years old, and he has a 2-year-old, and his wife and he, well, his wife and he's hit full retirement age. They're all going to get a benefit. Unmarried children through age 19 or through age 18 or 19 is still in full-time attendance in school. Children, any children disabled prior to age 22 are eligible on your record. The benefit amount, now remember, this isn't survivor benefits. This is everybody's alive. You're alive, your wife's alive, children are alive. That benefit, each of those beneficiaries get 1/2 of the wage earner's full retirement age benefit, subject to the family maximum. Now, that's unmarried children and children. The spouse or divorced spouse, age 62, is going to take a bigger reduction. Okay? They get 1/2 of it, and it's going to be reduced. The spouse or divorced spouse, any age with a child under age 16 in their care, they don't get reduced. They get 1/2 of your full retirement age benefit. So if you were getting $3,000 a month at full retirement age, they get 1/2 of it, up to a family maximum. Now, family maximum is usually about 150 to 180% of your full age retirement benefit. So somebody drawing $4,000 a month at full retirement age, the family maximum would be around $5,700. That's total payable to everybody. But there's a calculation which, I'm not going into today. It's a little bit complicated, but all these people are eligible on these records. Entitled is another question. If for a spouse age 62, it depends what that spouse can receive on her own record or his own record. Earnings limits apply to everyone here. Wives, children, everybody is subject to those earnings limits. Any questions, Jeff?
No questions on that. It does bring up a point. If you have anything you want to talk or discuss, comments, please put that in the question box.
Okay. Next slide. Yeah. Here's one of the myths, the biggest one I hear. My wife gets 1/2 of mine. Well, a wife could say, my husband gets 1/2 of mine too. And that's not always true. Here's how a spousal benefit is figured basically, all right? Let's say we have a family, all right? And our kids are grown, and now we have the high wage earner reaching age 65 or 66. They're going to file for benefits. Now, their full age retirement benefit might be $3,400, but they're taking it a year early, so it might be $2,900 is what's payable. Okay, but Social Security is always looking at the full age retirement benefit of the higher wage earner, whichever one it might be. And if it was $3,400 at their full retirement age, their spouse is entitled to 1/2 of that, $1,700, at the spouse's full retirement age. So we got two different full retirement ages here: the high wage earner and then the spouse. So if this spouse had never worked, that spouse would get one half. My wife would get one half, $1,700. My husband would get one half, $1,700. But most of them had worked. Okay? Subtract the low wage earner's full retirement age benefit, which is $1,200. This is the spouse's own full retirement age benefit. And you subtract from that from what they could get on their spouse's record. The higher wage earner record. So their real spousal benefit at full retirement age is $500, payable at their full retirement month. The higher wage earner must be receiving. Again, an exception is a divorced spouse. So in order to draw that $500 a month, he must, let's say he's the higher wage earner, he must have filed, and then she can get the $500 a month plus her $1,200 a month at her full retirement age. Taken earlier, those benefits are reduced, roughly 30% at age 62. So that's how you figure a spousal benefit. So it's not always true. My wife doesn't always get half of mine, or my husband doesn't always get half of mine, but they get part of the half, possibly. Now, if her full retirement age benefit, let's say she had some pretty good job, if it was $2,500, she'd get zero spousal benefit. $2,500 subtracted from $1,700, that offsets the $1,700 totally. People are confused about this, so if we got some questions, let me know. Okay, next slide.
Okay.
Go ahead, Jeff.
Yeah, we got the slide up for you. Yes.
Okay, slide. 2015 amendment, the spousal peril benefit. Carefully listen to what I'm going to say. You, meaning the spouse, must file for the spousal benefit when your spouse files for their retirement benefit if you are receiving or filing for your reduced retirement benefit. Explained a little more simply, the wife is age 64. The husband files. The wife's been receiving her reduced retirement benefit for a year, but now he files, and she can get something on his record. And if she files with if he files with June of 25, she's got to file with June of 25. She can't wait to get a higher spousal benefit at full retirement age. She must take that benefit when he files, if she is receiving her own reduced retirement benefit. I had a financial planning firm. They had to make amends with one of their clients because in 2015 they advised the spouse to wait 2 or 3 years until their full retirement age to get a higher spousal benefit. The law had just passed. They had no way of knowing, and they had forgotten all about it. So what they did was this spouse should have filed when she was 65 years old. But she waited until she was 67 and filed, get a higher spousal benefit. But he filed earlier, and she was receiving her reduced retirement benefit at the time he filed. So she had to take it then. So when they went in to file and she was age 67, Social Security said, we're not going to pay you the 67 age amount. We're going to pay you as if you filed at 65. And they lost about $500 a month over a 2-year period, roughly about $12,000. So anyway, this amendment is a peril, one of them. Next slide. Disability benefits. Social Security disability benefit. We're in a whole new arena here, folks. We're in a whole new arena. You must be insured and meet the disability severity test. And there's a 5-month waiting period. I'm talking about Social Security regular disability benefits that are based on your work and your earnings, and you become disabled and can't work, whatever it is. You must be insured. That means you need 40 quarters of coverage, and you need 5 years of work out of the previous 10 years under Social Security coverage in order to be insured. So you've got to meet what's called the 2040 test, 5 years out of the previous 10 years, and you need 40 quarters. Unless you're younger. People in their early 20s and 30s meet a different insured status test. You need less quarters, I'll put it that way. Keep it simple. Once you're 31, you need 40 quarters, and you got to meet the 2040 test or the 5-year, 10-year test. The other test you got to meet is the disability severity test. You must have a condition that is so severe that it's expected to last for 12 months or end in death. It's a tough test of disability. I do a number of disabilities through the year, and I make clear the first thing I ask them is get your Social Security statement. I want to see if make sure you're insured. The other disability program they have is supplemental security income, and if you look at the update handout, the back page gives you the qualifications, the maximums you're allowed to have as far as income and resources, and don't get supplemental security income. Supplemental security income is a needs-based program. It depends on your income and your resources. And you still must meet the disability severity test. Now, I have clients that are well off money-wise, and their children, a special needs child, can get SSI and live at home, because once that child turns 18, never worked, but they're disabled from birth, they can get supplemental security income and food stamps and Medicaid and live in that household with the parents, and also get disability benefits, child disability benefits on their parents when their parents file for retirement benefits. So there's a whole lot going on here, getting SSI and Social Security benefits. But usually when the Social Security benefits are, a child disabled prior to age 22. When a parent reaches age 62 or 63 and they file for retirement, then that supplemental security income goes away, because their benefit from Social Security, the special needs child's benefit from Social Security, usually wipes out any supplemental security income, because the maximum benefit payable is $967 a month on SSI. The other thing is, you need to know is that you can file for reduced retirement benefits and disability at the same time. You quit work, you're 63 years old, heart condition, a major medical issue going on of some type. You could take your reduced retirement benefits and file for disability, and your disability might be $400 or $500 more a month, because you're taking your retirement at 63. So instead of it being, say, $3,000 a month, it may be $2,500 a month retirement, but then your disability gets approved and it goes up to the higher amount for disability benefits. Disability benefits, they're equivalent to just about your full retirement age benefit. Okay, questions?
Yeah, we do got a couple questions, but they relate to the previous slide. I'm going to go back to that. And Michelle had a follow-up question. Remember, she was talking about early retirement. And her follow-up question was she makes 38,000 plus Social Security for 1 month, December, or should I wait till January of 2026? Do you remember her
Definitely.
first question?
Yeah. Yeah. If she's going to make 38,000
Yeah.
in December, or
Her first question,
38,000 a year.
um, yeah, I think it's for that year, or should she wait until January 26?
You should probably wait till January. Well, you can file effective September 1st to start your benefit in January. So you don't have to wait till January to file. You can file 4 months ahead of time. It's the month you elect to start benefits that's the key here. And I would, if you're making 38,000 a year, you turn 62 in September.
Mm-hmm.
You're not going to get anything probably at all. So you would elect January. Now the 38,000, they've got to withhold 10,000. They're going to withhold your benefit January, February, March until they get their 10,000 roughly, and then they're going to start paying you. That is one option. But I would,
Right.
in any case, knowing what you just said, I would wait till January to start your benefit.
Okay. And then we've got Carl talking about delayed spousal benefit. Let's see here.
You mean delayed
If I
retirement
file
benefit?
for, yeah, if I file for Social Security at age 70, is there any additional benefit to delaying spousal benefits for his wife who is 2 years behind him?
That is a great question. I run into this all the time. And if you wait till 70, okay, there's no reason to delay the spousal benefit. You file at 70, she would take the spousal benefit. The issue that comes up is some people are waiting to take the spousal and retirement benefit if she's waiting on her own retirement benefit. And 100% of the time, if she's going to get some spousal benefit when you turn 70, she should take her own retirement benefit at her full retirement age, whatever it is, not wait till 70 on her own retirement benefit. This is what you're leaving a lot of money on the table unnecessarily, because you're not going to get any more at full retirement age. Your benefit's going to be higher. For example, this is a great question. Running this all the time. Well, we'll just wait for both of us to wait till 70. Okay, well, she's got a very low benefit. She's got let's say $800 a month that she could take at full retirement age. And she's going to wait to have that increase to $1,100 a month at full retirement at his age 70. Well, guess what? The spousal benefit's going to be at age 70. The same thing it would have been at full retirement age if they both filed. You should always take your benefit, well, most of the time, take your benefit, she should take her benefit at full retirement age, not wait till 70. The only thing you're waiting till 70 for is because you can't get the spousal benefit until he files. So in summation, take your own benefit at full retirement age, then at 70, you file for the spousal benefit. That's why I do an analysis. I see this all the time. I go, oh my God.
And we're going to provide your contact information later in this presentation. It was on that first slide. We'll get back to that. So these are some great questions, everybody. Keep them coming. So let's go back to where we were.
You call me up. I'm interested in this situation. I want to talk to these people just to make sure that it's clear, because there's no.
Yeah.
I mean, it gets a little rocket science in there.
Yeah. Rattle off your phone number if you don't mind.
Yeah, 513-235-8036. It's going to be on the last page that we get to.
Absolutely. So I think we covered disability, right?
Yeah, we're
and then we're on
suspension.
Voluntary suspensions now.
Yeah, okay. Voluntary suspensions used to be the thing to do in the past, and then a man with the higher wage earner would file and suspend, And then his wife could take half of his benefit until he takes his benefit. Great strategy. Well, if you suspend now, nobody can receive on your record. And this has been this way since 2016. So the only time suspension makes sense is if you've got a disabled child and that disabled child can file on your record, not get paid, but if you suspend, the disabled child can file on your record, disabled before age 22, and draw benefits, and cannot draw benefits, but in 2 years would be eligible for Medicare. That's the kicker right there. Medicare eligibility. Voluntary suspensions make no sense except if, look at the fourth bullet. Suspension is possible between full retirement month and age 70, even if a retirement benefit was taken early at a reduced rate. So you took your benefit at age 62 and you took $3,000 a month at 62. It would have been $4,000 at 66. All right. So you took $3,000 and you get to age 70, you get to age 66 and you think, well, why did I do that? I took it early. You can suspend it and they will give you 8% per year for every month you don't take. So you're getting 8% on the $3,000, not the $4,000. You can do that still, but you can't go back and grab your benefit. If you suspended a year later and you want to start your benefit, it's going to start at the current rate it's in, not when you suspended it. And there's no retroactive right to a benefit. It eliminates the 6-month retro possibility. If you do nothing and you file at age 68, you can take 6 months back benefit, but maybe, $18,000, $20,000 in your pocket, retroactive benefit. So that's great. But if you file and take your benefit, or if you file and suspend, you've got no retroactive life benefit at age 68 or 67 or 66. If you want to start, once you suspend, you want to start your benefit, it starts the next month going forward. So not too many people suspend anymore. Here's a big one in 2025, actually 24. The WEP, windfall elimination provision, and the government pension offset provision. WEP affects someone's own retirement benefit. For instance, people work for the city of Cincinnati. They're going to draw a retirement benefit from OPERS for their work with Cincinnati. They did not pay into Social Security, but they still get a Social Security benefit because they may have some work in Social Security. Used to be the windfall offset that by up to $500. So if you could get $1,000 a month, it puts you into the calculator, you would only get $500 a month if you're drawing that $4,000 a month city pension. Government pension offset provision. Government pension offset affects spousal and widow or widower benefits. So if you have, if you have let's say a spouse that died and he worked under Social Security forever and he died 3 or 4 years ago, and you're drawing this state teacher's pension of about $33,000 a month, let's say. Well, 2/3 of that, $3,000, offsets anything you can get as a spouse or a widow or widower. Now you can get that benefit. You can get that spouse or widower benefit. So here's the key, okay? Both provisions were eliminated as of January of 24, and most people on the rolls got back pay. I got back pay. I got about $6,000 in back pay because the windfall was taken away effective January of 24. Okay, so I got a retroactive check last year, and my benefit my monthly benefit went up because the windfall no longer applied. Government pension offset, it really does get technical here, but government pension offset, if I were anybody and you had any questions, I'd give me a call. I'll give you guidance on this. But the first thing out of my mouth is going to be, you call Social Security and make an appointment. Okay? Because that's the only way to get this spousal or widower benefit. And a lot of people, I just had a couple in here the other day, and did not know. And they were, it's causing them to think about marriage again, okay? Because in order to get the spousal or a spousal benefit, you've got to be married for at least a year. But this spouse could get about $1,500 a month on his record now that this government pension offset is done. You are no longer offset for anything to do with the public pension that you receive from OPERS, from state teachers, from City of Cincinnati. You're no longer subject to the offset. And if you're confused and wonder if it applies to you, simply call and make an appointment to file and insist on filing. You want to file, you want to get an official record made, not take somebody's word for it on the phone. Believe me, a lot of them, not a lot of sharp tools in the shed anymore. Okay. WEP GPO, protect yourselves. Questions?
No, no additional questions, but don't hesitate.
Okay.
Survivor benefit.
Survivor benefits. You're eligible at age 60. This is an aged widow. Hate to put a label on it, but that's what they call eligibility in Social Security. It's either a aged widow or a young widow or widower. We're going to talk about the aged widow here. As a widow or widower, you're eligible at age 60. It depends how much you can receive on your own record, how much you can receive as a widow. Let me tell you, folks, these are people that need an analysis to sit down and see what's the smart thing to do. Take the widow benefit at an early age. If you're not working, you get into the fact of, are you making money and you're not working, or you're going to, at full retirement age, you might want to take the widow benefit at a higher rate and let your own grow till 70. So, but eligibility starts for a widower at age 60. A disabled widow or widower is eligible between 50 and 60 if they're disabled. A divorced widow or widower who's been married for 10 years and is at least age 60 is eligible. There is a 9-month duration of marriage requirement. So you must have been married for at least 9 months, except, and I had this happen, unfortunately, financial planning friend of mine married love of his life, evidently, and 6 months later he had a heart issue while scuba diving. And great guy, but 6 months, they were only married 6 months. It was an accidental death, so she's eligible. Earnings limits apply through your full retirement age for these survivor benefits.
So, Denny,
Now
I had a follow-up
Okay.
question to that personally. So let's assume that going back to the divorce spousal benefit, and they're under 60. They were getting that because they were married for 10 years.
Divorce spousal or widow?
Spousal benefit. And
Okay.
then that act dies. Okay, they had been married 10 years, and the spouse, let's say she's in her 50s, or she's under 60. So does she continue to collect the spousal benefit, or does she have to now wait until she turns 60 to get the divorced widow benefit?
She's got to wait till she was drawing a spousal benefit because she had a child in her care, not because she was 62. She was taking it before age 60.
Okay.
Okay. She can't get it before age 60 unless she's got a child in her care.
Right.
So if she took it at 60 and or 62, she took the spousal benefit at 62, and then at 63 he dies, then she's converted over. She'd have to tell them I want a reduced widow benefit, but she's eligible for it. She'll get a letter to say, hey, you're eligible for higher payments on his record now that he's deceased.
Okay.
And
so
they would
you actually get more.
Yeah. Yep.
You get more. Okay.
Yep.
Understood. Yep. Okay. Just wanted to clarify that. Thank you.
Okay. Okay, sure. We're on the survivor benefit, the young widow benefit. This is a different class of benefits. It's a widow benefit, but this is a mother or father any age caring for a child of age 16 or younger. And that means any age. This woman, you could be the one lady I had last week was 41 years old and had a 2-year-old. Okay. So mothers and fathers of any age caring for a child 16 or younger. There's a 9-month duration of marriage, except if accidental death. Children's benefits through age 19 or if in school are eligible, or if disabled prior to age 22. The benefit amount is 75% of the full retirement age benefit subject to the family maximum, not 1/2, as in spousal or children's benefit if you're alive. This is a survivor benefit. And you can get up to the family maximum. Earnings limits apply to everybody. So this is a young widow with young children in her care, or his care, as the case goes. Okay. We're
Got one more question
here
before we go to the next slide. And this is a general question. What percentage of Social Security income is taxed?
Social Security benefit income?
The question is, what percentage of Social Security income is taxed?
That depends on your tax filing. And that's a good question for this year because, you know, we heard, oh, no taxes on Social Security. Well, that's not true, okay? And now there's an additional deduction of $6,000 per 65-year-old. I think it's 65-year-old or younger, or maybe 60. I forget what it is, but you need to check with your accountant how that's going to affect you, because I don't know, okay? Because you're getting an extra deduction, but you're going to pay $6,000. Let's say a married couple is going to get $12,000 total extra deduction. Well, you know, look at how much Social Security you're making. You're making probably $40,000, $50,000, $60,000 in Social Security benefits, somewhere around there. Some of that's going to be taxed, and it's up to each individual, you know, because they're looking at your adjusted gross income from other total, and they're looking at other income you have too. So Social Security benefit can be taxed at a maximum rate or at a lot less now. And I especially don't know. That's an accounting problem. That's where you go to the bean counter. Okay?
Yeah. Okay.
Myths. Okay, next slide. We'll go to they said myths. We're about they said. Well, I'll give you one example of they said. They is relatives, co-workers, friends, even HR departments sometimes say the wrong thing. You make too much money, you can't draw Social Security. Okay. So she waited until she was 70. This is an employee with a company. She waited until she was 69 and a half. And then her company sent her to me for an analysis. And I looked at it, I said, divorce. I said, when'd you get divorced? She said, oh, well, that was 15 years ago. He died last year. or no, 3 years ago. And I went, oh boy. Well, somebody at work had told her, they had told her, you're making too much money. She was in the marketing division of a company and making about $140,000 a year. What the person didn't, she just listened to that face value, and she was 69 and a half years old. She could make as much money as she wanted to, draw the widow benefit, divorce widow benefit of $3,000 a month. And she had left 2.5 years of that on the table. Okay, 3.5 actually. We got 6 months, but she left somewhere in the neighborhood of about $90-some thousand on the table because of what she listened to a friend at work. So be careful. You know, the old, well, my wife gets half of mine. Well, that could be true. Another great one is you've got to file for Medicare Part A at least. Even if you're on a group health plan at work, you got to file for Medicare Part A or you're going to get penalized. That's absolutely false. And the website, if you go to Social Security's website, it'll make you believe that if you read literally what they're saying. But if you're on a group health plan with 20 or more employees with the company, you don't need to file for Medicare. Because if you file for Part A, you can't take the tax deduction for your HSA contributions anymore because you're on a public health plan, Part A, and you're not even going to use it. So be careful. Consult with an expert. Give me a call. Let Social Security tell you wrong. That's the next slide. Misinformation from an official source. All right? Now, when you go to Social Security and they give you, oh, you're making too much money, and you leave, Social Security, you go to a window there and take a number and talk to somebody. They're making electronic documentation of their conversation with you. And I had a friend of mine that went there to the local, one of the local offices here in Cincinnati, and they told her, oh, you can't get half your husband's because your benefit's higher. Well, that's not true. Not back then it was. And this is in 2012. And she could have filed and restricted and drawn about $23,000 over a 3.5-year period on her spouse's record because he had suspended. Well, that was an incorrect information, and we went back there. They found the electronic documentation, and an employee from an official source gave her, and a year later, they approved her claim, and she got about $18,000 back there. So if it's coming from an official source, and believe me, through the years, especially during COVID, there were people, I had one person I dealt with in, I believe it was a Maryland office. That's all she did was misinformation complaints because their training had become so poor, because people went home and people didn't get trained and they were giving out bad information. But protect yourself when you're dealing with Social Security. Keep a journal. Date, time, name, what they told you, what to expect. You'll hear that again before we're done, and I'm almost done. Here's the practical information. Calling the 800 number, 800-772-1213. It's available from 7 a.m. to 7 p.m. I would call from 11 a.m. to 7 p.m., never before 11, because the East Coast isn't up yet. There are teleservice centers throughout the United States. You want to call when all of them are up. If you call at 7 in the morning, you've only got the East Coast open, not all the United States. So don't call on Mondays. Don't call on days after holidays. In fact, don't call at all that 800 number because there's technical difficulties with the information they give out, I think, personally. And I'll argue with anybody about that. But you want to call that number to make an appointment. That's what that number is there for. After that, they're good at mailing out papers and telling you to file appeals and things like that. Local office hours are 9 a.m. to 4 p.m. I would deal with the local office on every issue I have if I were you. Filing, you can file online or call and make an appointment. But you can't file spousal claims or widower claims online. You can only file them by making an appointment. Overpayments, if you're ever overpaid, you can offer them an 80% compromise and they'll take it. Cash on the barrelhead. So you're overpaid $1,000, you can offer them 800, they'll take it. Everybody should have a My Social Security account and keep it up to date. I can't tell you how many people I talked to. I said, what are those blank years back here in 2015 and 16? Oh, I don't know. I didn't see them. Okay. Just check your account every year. And of course, keep a journal. Every contact, every phone conversation, every time you go into an office, just keep a journal, what they said, date, time, and place. Well, it's been great being here today. Here are my fees. I do an analysis for individuals, $325, for couples, $595, and this is all on my website, ss-help.com. And here's my phone number, and there's the website. If you have further questions, especially if you are a web person, but more especially if you're a government pension offset possibility, you need to call me so you don't lose any more money, possibly. Thank you, Jeff, Jessica, and
Yeah.
thank you for being here today.
Thank you, Denny. And just want to follow up. Carl was so kind. He provided a link to, the deductions for seniors that Denny was alluding to. This came from the IRS, irs.gov newsroom, having to do with the big, beautiful bill. I put that in the chat. That's a link you can open up from IRS, telling you more about that. And Denny, sensational job as always. Folks, if you got a question for Denny, don't hesitate to give him a call or go out to his website. And this recording will be available to you guys. We're going to send that out to you. Bertha, can you clarify what you're saying here? Can you put again the last before last? I'm trying to, maybe she can clarify that. I'm not sure what she was saying. Okay.
Give me a call.
Regarding hourly rates, I want to go back to the hourly rates. There they are. So
Okay.
Social Security Solutions Services, I got that screen up. Those are the analysis, the online retirement filing, the disability claim filing, and other issues. So, okay. I'll go back to the final screen there with his information. Fantastic job, Denny, and we really appreciate you joining us again this year. And
thank you.
You bet. With that, I'll conclude the presentation. Thank you, everybody.
Okay. All right. Thank you, Jeff and Jessica. Appreciate it.
You bet.
Thanks, Denny.
Bye-bye.